In 1998, long-term capital management lost $150 billion in just 4 months, nearly collapsing global markets. Expected to recover, banks instead faced a $500 billion crisis. Old strategies versus new risks. No one talks about the hidden risks in leveraged bets until it's too late. As screens flash red and phones ring, the Fed scrambles to avert disaster, saving banks, but burying the real cause. The real reason, a flawed strategy taught in no classroom, yet it's replicated daily by investors worldwide. But here's the kicker. The strategy that destroyed LTCM was taught in Ivy League classrooms. They assumed markets would behave like they did in the 1960s. They were wrong. John Meriwether, the man who built Salomon Brothers' bond trading empire, had a new idea: arbitrage. He recruited Nobel Prize winners Myron Scholes and Robert Merton, who had just created the Black-Scholes model for pricing options. Together, they formed LTCM in 1994. Their strategy: buy undervalued bonds in one market, sell overvalued ones in another, and wait for prices to converge. It sounded foolproof, but they relied on data from the 1960s, 1980s, assuming markets would remain stable. They didn't account for the 1997 Asian crisis or the Russian government's 1998 default. The collapse wasn't just about bad bets. It was about ignoring history. LTM's computers spat out losses. $4.6 billion gone in 1 week. The Fed had no choice. They forced JP Morgan Chase to bail out LTCM with a $3.6 billion loan. Without that, the global financial system would have unraveled. This wasn't the first time leverage destroyed a market. In 1929, over-leveraged banks like Bank of the United States collapsed, triggering the Great Depression. LTCM's failure taught regulators a lesson, but they ignored it. In 2008, Lehman Brothers took similar bets on subprime mortgages. Their leverage turned a 10% housing crash into a 90% loss. The human cost was staggering. Lehman's employees lost decades of savings. John Meriwether, a former Salomon Brothers trader with a reputation for spotting market inefficiencies, had built a career on exploiting tiny price discrepancies. But LTCM wasn't just another hedge fund. It was a machine powered by Nobel Prize-winning minds. Myron Scholes and Robert Merton, who had just developed the Black-Scholes model for pricing options, joined Meriwether in 1994, convinced they'd found a way to make markets predictable. Their strategy: arbitrage, the art of buying undervalued assets and selling overvalued ones. Betting prices would converge. It worked, until it didn't. The Federal Reserve, led by Alan Greenspan, watched LTCM's bets with growing unease. By 1998, the fund had leveraged its $10 billion in capital. $25 Watson, controlling $250 billion in assets. A single 2% market move could erase $5 billion. When Russia defaulted on its debt in August 1998, LTCM's bets unraveled. Their computers flashed red. $4.6 billion vanished in a week. The Fed had no choice. They forced JP Morgan Chase to bail out LTCM with a $3.6 billion loan, a move Greenspan later called a necessary evil to prevent a chain reaction. But the real problem wasn't just leverage, it was the blind spot in LTCM's thinking. They'd built their models on data from the 1960s, 1980s, a period of relative market stability. They ignored the 1997 Asian crisis, which had already shattered assumptions about emerging markets. Scholes and Merton had warned that their models couldn't account for black swans, but LTCM's leadership dismissed the risks. Meriwether, who'd once bet against the U.S. government in the 1987 crash, now found himself on the other side of history. As the Fed scrambled to contain the fallout, LTCM's employees watched their life savings evaporate. Scholes, later speaking to the Financial Times, admitted, "We trusted the math too much. We forgot markets are driven by human behavior, not equations." The bailout wasn't just a lifeline, it was a warning. A warning regulators would soon forget. Arbitrage is the art of buying low and selling high simultaneously, like a magician pulling a rabbit from a hat. LTCM's model was elegant. They'd spot a 0.5% price discrepancy between US Treasury bonds and similar instruments in Europe. Buy the cheaper one, sell the more expensive, and wait for markets to correct. In theory, it was a free lunch, risk-free profit. But theory didn't account for the 1997 Asian crisis, where panic turned a 0.5% gap into a 5% gap overnight. Their leverage was the real weapon. With $10 billion in capital, LTCM borrowed $240 billion, controlling $250 billion in assets. A 2% market move, just a whisper in the financial world, erased $5 billion. When Russia defaulted in 1998, their bets on Russian government bonds collapsed. Their computers flashed red. $4.6 billion vanished in 7 days. The Fed had no choice. They forced JP Morgan Chase to bail them out with a $3.6 billion loan. But LTCM's math was flawed. The Black-Scholes model, which Scholes and Merton had developed, assumed markets followed a normal distribution. Prices moved in predictable, bell-shaped curves. In reality, markets had fat tails, meaning extreme crashes happened far more often than the model predicted. LTM's computers didn't factor in human panic, geopolitical shocks, or the 1997 Asian crisis, which had already shattered assumptions about emerging markets. This wasn't the first time overconfidence led to disaster. In 1929, banks like the Bank of the United States leveraged 10,001, assuming the market would never crash. When it did, their bets turned a 10% drop into a 100% loss. LTCM's 25-1 leverage was even more dangerous. Their strategy wasn't just wrong, it was a mirror of the 1929 crash, dressed in Nobel Prize equations. Employees watched their life savings evaporate. Scholes, later speaking to the Financial Times, admitted, "We trusted the math too much. We forgot. Markets are driven by human behavior, not equations." The bailout wasn't just a lifeline. It was a warning. A warning regulators would soon forget. The Fed's intervention was a temporary fix, not a solution. By 1998, LTCM's collapse had already triggered a cascade. Banks scrambled to unwind their bets, trading volumes spiked, and credit markets froze. The Fed's $3.6 billion lifeline to JP Morgan Chase wasn't just a bailout, it was a desperate attempt to prevent a chain reaction. But the damage had already spread. The Russian default had shattered confidence in emerging markets, and LTCM's bets on currency swaps had exposed a flaw in global financial architecture. No one had considered how interconnected leveraged bets could become. This wasn't the first time a financial system teetered on the edge. In 1929, over-leveraged banks like the Bank of the United States had collapsed under the weight of their own speculation, triggering the Great Depression. LT's 25,001 leverage was even more dangerous. Its bets weren't just on stocks or bonds, but on the convergence of prices, a theory that assumed markets would always behave predictably. When they didn't, the math turned against them. The human cost was staggering. LTCM's employees watched their life savings vanish in weeks. One trader, who had invested his retirement savings in the fund, lost $2 million overnight. Scholes, later speaking to the Financial Times, admitted, "We trusted the math too much. We forgot markets are driven by human behavior, not equations." Yet, while LTCM's collapse was a warning, regulators ignored it. In 2008, Lehman Brothers took similar bets, this time on subprime mortgages. Their leverage turned a 10% housing crash into a 90% loss. When Lehman collapsed in September 2008, the world watched as the financial system unraveled. The Fed's response: a $700 billion bailout, a move that echoed LTCM's rescue, but on a far greater scale. But not everyone suffered. JP Morgan's CEO, Jamie Dimon, had made a fortune bailing out LTCM in 1998, only to face a similar crisis in 2012, when his own leveraged bets nearly collapsed. The lesson was clear. Leverage doesn't just amplify gains, it amplifies ruin. The margin of safety concept, popularized by Benjamin Graham in the 1930s during the Great Depression, remains a forgotten lifeline for investors. Graham argued that true value lies not in chasing peak prices, but in buying assets at a discount to their intrinsic worth. In 2008, investors who adhered to this principle, like Warren Buffett's Berkshire Hathaway, avoided the worst of the crisis by holding undervalued banks and utilities, while others who bet on housing prices collapsing saw their portfolios vanish. Yet, today, few teach this lesson. Consider the 2022 GameStop short squeeze. Retail traders, armed with $100,000 in borrowed money, bet against institutional investors, only to watch their leverage amplify losses when the stock rebounded. One trader, who had borrowed $500,000 to short the stock, lost $2 million in a week. Proof that even modern markets still reward speculation over patience. The hidden tax of leverage isn't just mathematical, it's psychological. In 1998, LTCM's employees were told by Scholes, "The models are flawless, the data is perfect." But when Russia defaulted, their confidence crumbled. Today, algorithmic trading platforms sell risk-free portfolios that promise 15% annual returns, masking the same blind spots. The Fed's 1998 bailout of LTCM was a warning ignored. In 2008, the same regulators watched as Lehman Brothers' $639 billion in leveraged bets collapsed, triggering a $16 trillion global market plunge. The difference? No one bailed out the banks this time. Just a $700 billion TARP fund and a $19 trillion stimulus. The real lesson isn't just about leverage, it's about power. In 1998, JP Morgan's Jamie Dimon made $1 billion from LTCM's collapse. In 2008, he lost $2 billion betting against mortgage-backed securities. Power shifts when you understand the language of money. Money talks, but only if you understand the language. Subscribe for more stories behind the economy. Tell us in the comments, did you see this coming?